A warm welcome to everyone for joining us today and across time zones, I'm sure. Today's webinar is on scaling up of adaptation finance in emerging economies and developing economies for agriculture and farm communities. This is organized under the aegis of Climate Week New York and is a joint partnership between CIFOR-ICRAF, auctusESG, Forum for the Future, GIZ, and KfW Development Bank. We have an exciting list of speakers and panelists today who will discuss the ways to address institutional barriers to private investment flows and financing restorative solutions in adaptive finance. To begin with, I'm going to give a quick introduction of the organizations who are partnering this event. CIFOR-ICRAF, who work extensively on restoring biodiversity and on issues of climate change, food security, livelihoods, and inequality. With partnerships in 64 countries, it is a pioneering organization with extensive research and work on agroecology. Our next partner is Forum for the Future, who is a leading global sustainability nonprofit. The organization specializes in addressing critical global challenges on climate and sustainability issues by creating a worldwide community of pioneers and change makers. Glad to have GIZ as our partners today. With over 50 years of experience, GIZ has worked across institutions on issues related to employment promotion, energy, environment, peace and security, and it has worked across 120 countries. Our next partners today is KfW Development Bank. For around 60 years, they have been financing and supporting programs for public sector players in developing countries and emerging economies to fight poverty and to protect both environment and climate. Last but not the least, we have auctusESG. It's a global expert advisory firm in climate finance, ESG, climate risks, aimed at integrating global sustainable finance and climate transition. The organization stands at the intersection of finance, investments, and sustainability, and has been awarded marquee projects by international governments, multilaterals, and financial institutions. I would now like to extend a very warm welcome to all our esteemed speakers today. My introductions are going to be very, very short, and this is not an indication of your illustrious careers. So first off, we have Ms. Anna Biswas, Managing Director, Forum for the Future. In her role, Anna is responsible for the operations and impact of Forum in India. Welcome, Anna. Next, we have our own Namita Vikas, founder and managing director at auctusESG. Namita is an award-winning senior business leader with over 3 decades of diverse global experience in sustainable finance, ESG, climate strategy across banking and technology. Hello, Namita. Next, we have 2 wonderful speakers who will deliver the special address. First, we have Mr. Sandeep Bhattacharya, who is an advisor climate change at GIZ. At his position, he is responsible for flow of finance for climate and impact causes. Hello, Sandeep. Next, we have Ms. Franziska Salzer, sector economist for agriculture finance at Germany's KfW Development Bank. Franziska has an MSc in agriculture economics from Humboldt University, Berlin. Welcome, Franziska. Now I move on to our keynote speakers. First off, we have Dr. Dalia Abdel Kader, Chief Sustainability Officer, Commercial International Bank, Egypt. Dr. Kader is a recognized expert in the field of sustainable finance. She is also a banking board member of UNEP-FI's Principles for Responsible Banking, representing the MENA region. Hello, Doctor. Next, we have Dr. Saleemul Huq, who is the Director at International Center for Climate Change and Development, ICAD, Bangladesh. He's an expert in climate change and sustainable development, particularly from the perspective of developing economies. He's not able to be with us physically today due to prior commitments, but we have a video screening from Dr. Saleemul Huq. Now I move on to our panelists. First off, we have Mr. Ravi Prabhu, Director, Innovation, Investment and Impact at CIFOR-ICRAF. Ravi is an accomplished scientist. He is also the recipient of Queen's Award for Forestry at Buckingham Palace in 2005. Hello, Ravi. Next, we have Ms. Alessandra Sgobbi, who heads the Climate Finance Unit of European Commission's Director General for Climate Action. Welcome, Alessandra. Mr. Ben Vickers is next. He is the Sector Senior Specialist, Land Use, Forest and Ecosystems, Green Climate Fund. Ben has over 24 years of experience in working on national climate change mitigation and adaptation policies. Hi, Ben. Next, we have Mr. Anilkumar, founder and CEO of Samunnati. With 3 decades of experience in areas of rural, retail, and agri banking, Mr. Anilkumar is a visionary who has received several awards and recognitions. Just to name a few, he was awarded Real Leader Impact Award in 2020. Also in 2020, ET Social Enterprise Startup Award. Hello, Mr. Anilkumar. Next, we have Mr. Ajith Radhakrishnan, Senior Specialist at 2030 Water Resources Group at the World Bank, India. Currently, Ajith leads an impactful initiative to scale up water use efficiency in Uttar Pradesh and Maharashtra. Hello, Ajith. Welcome. Next and final, we have Ms. Kristina Anguelova, Head Sustainable Finance, WWF Singapore. Kristina oversees technical teams across banking, investment, financial regulation, and ESG technical training. Hi, Kristina. So a very, very warm welcome once again to all of you for joining us today. A few quick announcements. As you see, there is a long list of speakers. So I would sincerely request the speakers to maintain the prescribed speaking time. For the participants, please enter your questions in the Q&A box and the moderators will take up the questions. And I'm also happy to inform that this event is being live streamed on CIFOR-ICRAF's LinkedIn page. Let me quickly go over the plan for today's session. First off will be the welcome address by Ms. Anna Biswas. This will be followed by Namita Vikas, who will set the tone and context for today's discussion. Then we have 2 special addresses by Sandeep Bhattacharya and Franziska Salzer. This will be followed by keynote address by Dr. Dalia Abdel Kader and a video recording by Dr. Saleemul Huq. After this will be the dynamic panel discussion, which will be moderated by Namita. Now over to you, Anita Biswas, to deliver your welcome address. The floor is yours.
Thanks, Sudha. A huge welcome to you all listening and watching, and to our great lineup of speakers today. Thank you for joining us. It's a real pleasure to collaborate with auctusESG and our other esteemed partners on this webinar. It's great. As you've just heard, we're here to dive deep into one of the most critical unlocks of our time, financing the adaptation and decarbonization of our food systems. We all know that the world's agriculture sector is increasingly vulnerable to climate change. The evidence of its impacts on food security is growing worldwide and more prominently in emerging and developing economies. Rising temperatures, heat waves, droughts and floods, changes in rainfall patterns and extreme events affect agriculture more than any other sector. Sometimes it is sudden catastrophic moments like the floods we have seen in multiple countries this year. For others, it is a slower battle, trying to manage changing pest or disease patterns as rain and temperatures change year on year, for instance. Nowhere are these challenges more keenly felt than by the typically smallholder farming families in the emerging and developing economies. Thankfully, this rising awareness of vulnerability is leading to intercommitments. Agriculture and food security featured prominently at COP27 in Sharm el-Sheikh last year, with governments working on stepping up action to cut greenhouse gas emissions and adapt to climate change in the agriculture sector. This included agreement on a new 4-year plan on agriculture and food security and a new initiative aimed at scaling up finance to transform agriculture by 2030, that I'm sure at least one of our speakers would be able to tell us more about. As Dr. Agnes Kalibata, President of the Alliance for the Green Revolution in Africa, has pointed out, practical lessons that can be scaled do exist, from sustainable intensification of food systems to regenerative agriculture to agroecology and related agroforestry. Such solutions offer us an opportunity to build food, social, economic, and ecological resistance to the negative effects of climate change. These practices work towards empowering communities against hunger and poverty and ensure inclusion of marginalized communities and people. Done well, these are routes to truly transformative adaptation, but they need finance, and there is no one silver bullet. Our Workers' Forum for the Future on what is needed to accelerate the transition to regenerative agriculture in Madhya Pradesh, one of the largest states in the heart of India, has shown the variety of needs and therefore the need for a variety of different financial mechanisms and instruments. From the patient capital to bridge the transition years from mainstream to agroecological practices when yields take a dip, to enterprise investment as more businesses fill the gaps and create, for instance, the much needed cold chain, to blended finance that enables the de-risking of private capital going into the sector and therefore the attraction of greater sums, to understanding the real role of crop insurance, to working out how payment for ecosystem services might provide an additional on-farm income equitably, These are just a few of the needs we hear in our work, and I have no doubt you have all heard additional needs and solutions. Our work has raised some pretty fundamental questions that need to be considered when designing and implementing these finance solutions for adaptation in agriculture. Some even raise questions about the finance system itself. For instance, is it actually access to finance that is the issue, or something else, such as the finance model itself that focuses too heavily on risk-return profiles versus ensuring adaptation actually can occur? Making something investable is very different as a goal from supporting accelerated adaptation. It's generally assumed that bringing mitigation and adaptation financing out of the public financing space into commercial and private financing is what is needed to scale up adaptation financing. But is it? Given the private sector still needs to answer to underlying investors and shareholders, do we need to look at the possible less desirable and unintended consequences of doing this? And how do we avoid the systemic implications on the market if large institutions are negatively impacted or large losses from their lending? Because there will be a market fallout which could possibly compromise further financing in this space. And there's always insurance to touch on. What's the role this sector must play to accelerate and scale up adaptation financing? I'm excited to hear from our speakers today on how these needs can be met in a just and regenerative way, and how these emerging solutions can be deployed rapidly at scale and help us tackle the inequity and ecological extraction that has typified our food system for the recent period. So without further ado, all the partners welcome you to this webinar and invite you to sit back and absorb the insights and get inspired.
That was wonderful and very short and to the point. Thanks, Anna. Very insightful, especially when you said, is it access that's the problem or is it the models? Very well said. Thank you so much. Now, I would like to invite Namita Vikas to set the context for today's session. Over to you, Namita.
Thank you very much, Sudha, and may I extend a very special welcome to all the speakers and panelists. I very well agree with Anna that this session would serve as a knowledge base towards fueling adaptation finance for agri and farm communities, especially looking at developing markets. Well, if we touch upon the empirical data in 2021 and 2022, globally, there were more than 300 natural disasters that inflicted at least about 300 billion in economic damage. And tropical countries, as we know, are increasingly exposed with damages caused by climate-related or earth-related disasters in Asia. And that too estimated to about $36 billion of impact last year. Now, UNEP has put out certain numbers where it says that the annual climate-related damage in developing countries alone cost about $70 billion, with the potential to reach about $300 billion by 2030 if no investments are made in adaptation. Therefore, there is an urgency for adaptation capital to flow into ecological, social, and economic systems in response to actual or the expected climate stimuli and their effects. Now, this would help to sustainably reduce climate change costs while advancing a range of other economic data. And, for example, if you look at low and middle income countries investing in more resilient infrastructure yields $4 in benefits for each $1 invested. Every $1 million invested in climate adaptation infrastructure, say in the construction sector, creates about 450 jobs in India, about 200 jobs in China, and about 160 both in Brazil and Indonesia. I think these are very important data points to put out. But despite the all this emerging as a pressing priority, the adaptation capital flows remains very inadequate. In December 2022, only 14% of global climate finance targeted pure adaptation. For developing countries, I think this is again further low, and international adaptation finance flows are almost about 5 to 10 times below the estimated needs, with annual costs reaching up to $340 billion by 2030. especially for agriculture and farm sectors, the topic of the discussion today, which requires nearly 26-fold increase in annual funding. And financial flows for agriculture, forestry, land use, and natural resource management sectors. I think one of the components of the food system, very important. This amounts to only $20 billion of annual flows, less than 4% of the total climate finance. And there is a shortfall, right? But I think it's also important to understand why it's not happening and what are the challenges around this from a banker's lens, a financier's lens. I think as it is, emerging economies like India and others face several barriers in financing adaptation. These include limited fiscal space that hampers adaptive ability, worsening climate shocks, rising risk premiums, and increasing the cost of borrowing in global financial markets. When debt costs are higher, adaptation measures are even less visible, right? And progress is also blocked because of underlying challenges riddled across the system. One, adaptation projects often have unproven concepts, making these high risk due to unreliable revenue sources. Lack of evidence of successful projects is very limited. Then there's a very high dependency on externalities and minor fluctuations that has the ability to reduce revenues, heightening the risk profile, making investors reluctant to show interest. Given the relative novelty of this sector, project developers are not able to show track record in developing cash flow generating projects, and most projects need upfront investment and start producing cash flows only after a few years. And I think one of the other important points is that in adaptation, ecosystem restoration kind of projects, they tend to have multidimensional benefits. Some preventing future losses, some direct benefits to the community, and it also sometimes make it difficult to monetize. For example, preserving wetlands can avoid floods, but this benefit is very difficult to quantify or to be translated into returns for investments or communities for that matter. Added to these overarching challenges, the financial sector comes up short as it lacks the means and the expertise to develop products beyond the narrow investable criteria. And I think overall, if we look at the scalability and bankability of projects that is required in the food and the land sector alone, there is an annual business opportunity of about $4.5 trillion by 2030, including forest restoration, sustainable aquaculture, plant-based meat, precision and regenerative agriculture, and reducing food waste. We also now have the Task Force on Nature-related disclosures, financial disclosures, TNFD, that has published its final recommendations, integrating nature into financial and business decision-making. And this is bound to pivot towards nature-positive outcomes and nudge financial institutions to consider these parts of the portfolio. I think for financial institutions, this is a big opportunity, and evolving with instruments that can deliver long-term sustainable asset creation and work to understand how climate change can affect assets at the point of design and implementation. I think that's going to be very important. Lastly, towards, I think, this webinar that we are doing, it would be very interesting to hear from all the panelists. But there are a couple of points that I want to put out. I think building an adaptation framework would be very, very necessary. One that would work with the ecosystem to enhance capacities and facilitate investment making that would achieve sustainable inclusive growth. On the second side, defining a clear approach to address capacity needs and support credible measurement, management, and maximization of long-term positive impacts of investment. I think it will be interesting to hear views of others who are here. I am right now at the Climate Week, in New York, and there are so many discussions on creating bankable and viable projects, replicable projects for multiple adaptation outcomes and mobilizing finance at scale. I think that is the topic of conversation. I will stop here and back to you, Sudha. Looking forward to the session. Thank you.
Wonderful. Thank you, Namita. That was really good. You brought out the urgency of adapting. Thank you very much. Now we move on to the special address by Sandeep Bhattacharya. The floor is yours, Sandeep.
Thank you. And this is a pleasure to be here. And Anna and Namita have laid out quite a few things, maybe at a certain macro level. We are trying to address them on the ground and trying to get our hands dirty in seeing what is possible. We don't claim we have all the answers. Is it, and Anna, you said, is it the returns model which is a problem? We really don't know. Maybe it is possible to have another financial model which works better for both mitigation and adaptation. But right now we just accept the world as whatever it is and try to make do and go and try to see. So very shortly, I mean, there was a lot of numbers which both Anna and Namita said, but I have my numbers are a bit outdated. Is that 2019 to 2020, around 46 billion was spent on adaptation, and less than 2% came from the private sector. So then that is basically our focus globally as well as in India. So I mean, without getting you too much into what and how a GIZ project works, but we have projects which cover multiple countries, and we have projects which cover a particular country or even certain region of a particular country. So one of our global projects looks at has kind of looked at the private sector and come out with three kinds of activity or three kinds of entities which act in adaptation. So the slightly larger companies who are investing in their own supply chain resilience, which it means a slightly larger companies, the MNCs of the world, or even a relatively small large companies. There are others who invest in the adaptation of others. I mean, there are a few business models which I think it is not enough time to go into too many of them. Drip irrigation would be one of them. And this is the most well understood, but there are plenty of others which is not that well understood. And then the third is providing climate adaptation for goods and services. Now the three are not completely vertically separated, but what our global project tries to do is focus on number 2 and 3, basically providing adaptation for others and providing climate adaptation for goods and services. So this project is called NDC Assist, and that project works with a lot of private equity funds, more than PEs, the impact funds, which are VCs and PEs, and as you know, which can invest only if there is a certain impact. And they marry returns with impact. They are generally not subsidized. And we have been able to procure some investments. The focus countries are Kenya, Nigeria, Rwanda, and Pakistan, but there is an investment in India also for a company which provides food drying and storage services at a decentralized village level, and then picks up the demand as and when necessary. Now back in India, we had a project called Climate Adaptation and Finance in Rural India, and which looked at various aspects of adaptation, including increased access to finance and also building the capacity of certain state governments, namely Himachal Pradesh, Uttar Pradesh, and there are plenty of audience who's outside of India, so I won't bore them with this. In terms of access to finance, we are very lucky to have worked with the National Bank of Agriculture and Rural Development, where we picked up one pilot project, which is about processing of millets at a central Indian state of and a place called Mandla, where NABARD came up with nearly around 70% of the entire package cost required as grants. So it's not NABARD, it's NABARD managing those grants, which allowed for the 30% commercial finance. It's a processing plant which is being set up now. Our technical assistants helped achieve financial closure, and it is likely to have multiple ripple effects including more plantation of millets and the whole sector becoming more economically viable, because then that they can process them and then trade, which is now just the raw produce goes to somewhere else from where all the trading happens. So that can have multiple benefits. And we are now trying to see whether there are other possibilities and scaling up and replicate and maybe do 8 to 10 of this year. Over the next 2 years. And last but not the least is the role of startups. Now, I was at an event called ClimaFix at the Indian Institute of Technology, Madras, on Thursday and Friday. And well, if you were there, you could have as well believed that startups and financing is going to solve this problem. Not totally, I agree, not totally, but it was so engrossing that you could actually start believing that. So what we have done is, along with our partners, the Sustain Plus Energy Foundation, which is a part of the Tata Trust Group, and a few sister concerns who have done extensive trials of some of these technologies on the field. And there are users who are now saying, yeah, I've used this one, the first one you paid me 20% of the cost, I paid 20% of the cost. Now I'm willing to take a loan to buy the next one because the economics are proven. So now we are bringing them together in front of a few FIs and working on the process of getting loan disbursement. Some have already happened and some are very close. So I'm hoping by November we could report around 4 to 5 products which earlier did not have access to finance from formal financial institution sources. We'll start having that by November. And we have done this with via Sadhan, which is a group of microfinance institutions, microfinance and small finance and some NBFCs, who have mobilized the FIs and allowed us to prioritize this FI, matchmake this product, this FI, and then have gone through the whole process of getting the agreements done. An FI works with a certain systems. You just can't show them a product once and say, oh, it happened. So we are continuing that collaboration, and I'm very happy to see that 2 of the members of the panel, which is the 2030 Water Resources Group, and Samunati are here, who are some of our collaborators on this. We don't claim we have all the solutions, but given the horrendous challenges and given the certain limitations, we are trying to do whatever we can. So in another place, I said, there's a Hindi term called a narrow lane or patli gali, a very narrow lane. So we are trying to go through the narrow lane, which clearly exists, and then let's see if we can make it into a highway. Thank you very much.
Perfect. Thank you. Thank you, Sandeep. That was really nice. It was very good to know about some practical things that you were doing on ground. It was good to have a perspective rather than just talk of policy. Very nice. And we definitely missed attending the Startup Summit at IIT Chennai. Unfortunately, we had conflicting events. Thank you so much. Now we'll move on to the next special address by Ms. Franziska Salzer. Over to you.
Hi, everyone, and good morning, afternoon to wherever you're joining from. I'm really happy to be here. As mentioned, I work for KfW Development Bank, focusing on the topic of agricultural finance. And in this sector, we're currently implementing almost 1.3 billion euro in projects across more than 20 countries globally. Most of our portfolio, around 70% of those projects, have climate adaptation as a secondary objective. So have some component of the project targeting climate adaptation. But we want to become more ambitious here, and I really look forward to learning from the other participants today. But we were asked by auctusESG to share some experience from our project. So I'd like to share three insights that we've gained. And the first one is to leverage grant funding for incentivizing change. We work a lot with local financial institutions, so commercial banks or MFIs, to foster green agricultural finance, usually by providing refinancing, so credit lines, or providing financing for insurance products. But it's not necessarily the prime objective of these partners to serve the agricultural sector, a sector that's often considered risky and complicated by itself, and to drive the green transformation of their economies. So it's not necessarily an easy match Although, of course, you could argue that climate smart farmers are less risky from the financial institution's perspective. So here we find that a combination of loans and grants is a good tool for driving change. As a development bank, we usually provide loans, but we can access grant funding from the German government, with which we can support things like capacity building or product development or impact-focused investment grants alongside these loans. So our first insight is really the power of using grant funding in parallel with loans to incentivize change with the financial institutions. The second insight is to simplify the assessment of green loans for loan officers. So to make this as straightforward as possible, because we've really understood that the success and sustainability of our project hinges on these people's ability to effectively identify what qualifies as a green loan. So in several projects, we've worked with green lists, stating precisely which investments, such as the installation of drip irrigation or the renewal of shade trees in agroforestry systems, qualify as green. And ideally, these green lists are user-friendly tools and are part of the standard loan approval process. But developing these green lists is really challenging because, especially with adaptation, the eligible investments are really specific to the local context. And at the same time, you, of course, want to align as much as possible with international standards and taxonomies. In one of our projects, the Eco-Business Fund, we use sustainability certification as a simple proxy that requires no further detailed assessment by the loan officer. So if producers are certified, the loan officer can grant a loan as green. By simplifying this assessment and at the same time, of course, also providing some capacity building in parallel, we empower loan officers to identify adaptation investments more efficiently, which in turn accelerates the flow of adaptation finance to those who need it. And that brings me to my last insight, which is to broaden the focus beyond agriculture. So in our agri-finance portfolio, we obviously focus on loans and insurance for agricultural producers and SMEs, as we do in this webinar. But agriculture is usually just a small segment in the overall portfolio of financial institutions. And it's not efficient or attractive for them to implement a green strategy just for this niche. So my final insight is that we need to work with financial institutions on their entire portfolios, even if agriculture is undeniably a really important part of adaptation efforts. So in conclusion, these three insights, leveraging grant funding, simplifying the assessment of green loans, and broadening our focus beyond agriculture, have helped us, and I hope they'll serve as helpful takeaways. So thanks a lot for your attention. I really look forward to the discussions and the shared learnings that await us.
Thank you very much, Franziska. That was very nice. In fact, we are very keen to understand more on how you have developed this green list, something to discuss later on. So very nice. And I'm sure that panelists would talk more about what you mentioned on going beyond agriculture. Very good points there. Thank you. We'll move on now to our keynote addresses. First is by Dr. Dalia Abdel Kader. Over to you, madam.
Hello, everyone. Thank you so much. There is nothing more gratifying than talking to industry leaders and practitioners about the issue of
Madam, you are muted. Can you unmute yourself?
Oh, that has been for quite a while, or
No, just very briefly. You're back. Yeah.
So, I would like to share with you the story of Brain Trust. Brain Trust is an innovative adaptation finance business model that we introduced at COP27. But the story behind Brain Trust is something I want to share with you. Over a year ago, I was contributing to a panel arranged in a conference arranged by Islamic Development Bank, and my discussion was focused on sustainable food systems and the role of banks. And I was saying that as a young girl, a little girl, we learned that Sudan can feed the whole Arab region. And when I left the panel, I had a very interesting discussion with a senior executive at the Department of Agriculture and Food Strategy at the Arab League. And he told me Sudan can feed the Arab region and Africa and can export. And I told him, where is this study? And he told me, I have it. He shared it with me. In turn, I shared it with the leading executive at the bank. And he told her, we want to make sure, how can we fund it? And her feedback was actually, for me, it was like a turning point. She told me, it's an excellent vision, good literature, it's not bankable. And that was the starting point of Brain Trust. How can we make adaptation finance bankable? How can we prove the business case of adaptation finance? And let me recall with you that the first time adaptation finance was framed by the IPCC was back in 2001. They shifted the perspective from good to have to a must-have. That was over 20 years ago. Ever since, adaptation finance gets 10% of its global needs, right? So we only have $30 billion for adaptation finance, while reports indicate that we need around $300 billion. So this is the starting point. The next slide takes us a couple of steps backward. This is the reality check. Ever since we all signed the Paris Agreement, the whole world is not on track, evidenced by we're witnessing the 5 warmest years on record. So mitigation is not working. 10% of the global population is suffering starvation. So adaptation is not there. Why is this the case? So this is the reality of it. The point is that if we dive deeper, we find that we are facing a distortion of finance. We can prove the business case of a project funding fossil fuel, but we cannot prove the business case of funding agriculture, food, water, projects that support life. We don't have the business case. There is fundamental distortion in modern accounting because, as Anna mentioned and previous speakers, we cannot monetize the externalities. And that's why they're called externalities. They are outside our system, although they are core to our life. So as a result, we don't have adaptation finance is pigeonholed as domain of public finance because it is stereotyped as non-profitable. And that is the crux of it. The bright spot is that the global financial system has around $379 trillion of investable cash assets. We only need 1%. So our mandate is to move adaptation finance from the realm of public funding and concessional loans and target the 1%. And this is our exercise. The supply is there. We need $300 billion till 2030, $500 billion till 2050. And this is like 0.25% of the global supply. And this is the mandate of financial institutions, of development finance, academia, and this is what I'm getting at. And here, Brain Trust comes. It's about proving the business case of adaptation finance. And let me tell you, each and every one of us either know or came across a report that says that adaptation finance is profitable and it has a business case. The World Bank reports that the benefit cost ratio for adaptation projects is 4:1. So if you invest $1.8 trillion in adaptation, the combined benefit is something like $7.1 trillion. And if you invest $800 million in resilience projects, early warning system projects, you reduce losses by around $18 trillion. So the business case is there, right? It's very much evident. What is not there is the business models. We still work with old business models, thinking that we can meet the SDGs. And this is something that's fundamentally draining the whole financial system and the global system down. So what we did, we were inspired by the IFC Green Bond Project for CIB. We were the first bank to issue the Green Bond. And I think that was a very enlightening experience, because we started to have our environmental social risk management system. We started to onboard environmental specialists next to financiers. And this is where we started to monetize the environmental and social impacts. And we started to engage our clients and prove to them that water treatment, water desalination, agricultural project, they do have a business case, because the resources are constantly increasing in price. So it was very easy to engage. Once we monetize the environmental and social benefits or losses, the business case was very much there. But as I said, this entails new role of financial institutions, moving from funding bankable projects to leveraging our ecosystem to structuring and funding bankable projects. So we're adding a new layer, a new mandate for banks. That's, by the way, a source of profit, because this will be against fee. Banks have convening power to get the right ecosystem that Anna and you all talked about. I mean, we have scientists here around us. We have MDBs, development finance. Getting them together will be the new mandate of a bank. How to do it? Proving the business case entails that we need to address the risk return formula, and we need to ensure that there is a constant revenue stream, and we need to make sure that we get the business, the Brain Trust brand, to be impeccably meeting private finance investors. And to do this, it's new business models, it's establishing a governance mechanism that gets all stakeholders for each project, adaptation project. It should be precious enough, and it warrants the presence of a governance mechanism that includes academia, development finance, de-risking partners, everybody is in there. Because whenever we attend a conference and we have these small discussions, we see that every entity has a role, but there is a fundamental and a very critical disconnection between stakeholders. And this is why the whole picture is not there. So getting a governance mechanism for each project, addressing these steps, the project design makes a hell of a difference from making a project not profitable, and that's the realm of community funding and public funding, to making it profitable. The concept design, choosing the financing structure, whether it's a PPP, whether it's debt, whether it's equity, the climate finance instrument, whether it's a green bond, blue bond, sukuk, result-based performance, crowdfunding, whatever, the de-risking. There are multiple entities out there to de-risk. The ESG data and disclosure is very important that we need to be very much aware of, the auditing and the rating. So at the end, adaptation finance would be rated, would be a comprehensive program that addresses risk return, and the business case is there. Why is this the case? We have an excellent opportunity, which is the ISSB, the IFRS announcements. This means that global investors would need sustainable food, to invest in sustainable food systems or in adaptation, because now the focus is not on the single bottom line or the profit. The focus is moving towards impact. So if we do not move fast, get together and establish the business case of adaptation, it will be too late, because adaptation is existential for this part of the world. Thank you so much, and pleasure again to be part of this webinar. Thank you.
Thank you, Dr. Khalid. That was very nice. very comprehensive, the presentation.